The financial fallout, just one piece of why this market can't seem to rally. Our next guest, Keith Parker, says that stocks are cheap, and if history is any indication, now could be the time to buy. Keith, of course, is the head of U.S. equity strategy at UBS. Keith, great to have you with us.
Thank you for having me.
Why do you think the financials are trading so poorly, and are you bullish on the financials specifically?
We've been neutral, so we've had the valuation support, but in terms of drivers of fundamentals, we saw expectations for margins too high, slowing top-line growth, and risks around interest rates. I think we've seen a significant flattening of the yield curve, and fives, twos start to get to a level that is worrying for banks. I think what's being discounted now, when you're trading at a 40% discount where we were in 2015 and 16, a lot's priced in. I think you need to have that positive catalyst and some expectations of profit growth. And I think the real bull case, you mentioned banks are being asked to act like utilities. Well, they don't pay out like utilities. And to me, if you're not going to have that big ROE like you had last cycle, you need to deliver that return on investment and pay dividends. And they're doing that gradually, but you need to be very patient to get to that point.
You sound almost like you're in the camp, and we were having this discussion where you look at the price action, you think things should be okay for the financials. The valuation should be okay. They look like they've priced in a lot. Are you also grappling with that, sort of scratching your head saying, why is this group close to bear market territory at this point?
Yeah, I think you could say that for banks, you could say that for industrials, you could say that for semiconductors. It's across the board, a big derating, and cyclical stand out. We did some work historically where we get things wrong on the multiple. Earnings are up over 20% this year, and the market is down. We've had a bear market in the multiple. And what's interesting, if you look back historically, we want to ask ourselves, well, what happens next year? Does the market get it right? And what's interesting is that median returns and average returns in the year following are actually 16%, well above historic averages, and only 2 years of negative returns.
So why are you saying to buy the market right now? I mean, if 2018 wasn't a great year for stock investors, or basically any asset class investor did not do well, right? I mean, yes, across the board. And it seemed like you had every single tailwind going for the markets. Why should 2019 be different?
I think the derating in equity markets and assets in general is, first, interest rates rose, and we're seeing a pullback in the rise in interest rates, and we'll get another indication from the Fed and Chair Powell next week. And so lower interest rates should support asset prices, all else equal. The slowing growth and worrying about growth and the cycle, particularly outside of the U.S., has been a big headwind. And again, I think we'll see how that goes. But U.S. fiscal and holiday shopping here should help the rest of the world. And then lastly, trade. We have now, between now and March, with a number of political nuances in between to potentially price out that trade risk.
Do you worry that window of 2019, if there is some sort of resolution as it relates to trade, is going to be so short because we're going to get back to an uncertainty? We're going to get back to a political environment here where I think corporates are going to be kind of, a little cautious here. And then the last point you just made about the U.S. consumer here in the Q4, it seems like the whole global economy is resting on the U.S. consumer's shoulder right now. And that seems like a very dangerous place to be.
Yeah, I think resting on the consumer's shoulder, and are they delivering? I would say signs are they are. Do they have the potential to deliver even more in the first quarter based on lower oil prices and what we've done on tax refunds? Could see an incremental 1% boost as a percentage of income. And then on the point on trade, what we would say is it short-lived? I think part of it is pricing out first that de-escalation, but China's done something. They've stimulated their economy since June to fend off that potential impact of tariffs, and the U.S. also has fiscal stimulus playing through in 2019. So we wouldn't expect that to be as short-lived if there is that follow-through and growth doesn't come in as bad as feared.
Have you published your outlook for 2019?
We did. We published it November 13th when the market was moving plus and minus 2%, so always tough. Yes.
And your year-end 2019 target is?
So we are at 3,200.
Okay.
We're a 10% plus return from where we think we could end the year. But obviously trade, growth, and interest rates are the key.
Okay. Thank you, Keith. Good to see you. Keith Parker of
you.
UBS. It's a treacherous time to be a U.S. equity strategist.
Treacherous.
Having to put out these forecasts, right?
But
for
who's
next
better
year
than a guy like Keith Parker I was going to ask him about we goodbye the guest. So.
I clearly said goodbye to Keith
So I'm not going to
Parker.
bring him back in.
Thank you.
But, we might see 3,200 at the end of next year. Absolutely. Where do we go first, though, is the question. I think
that's the big
Steve would
question.
submit we're going to retest those lows 25.30. I think there's a reasonable chance of that happening. Pete Najarian said last night, and I agree with him, volatility is too cheap in this environment. And I think Dan would agree with this, and this is not a political comment, but I don't think the market is at all pricing in something coming out of this Mueller investigation. That, again, not political, but it's definitely hanging out there.
Do you think we test February lows by the end of the year?
Yes, I would like to see them tested. The only problem that you have with testing them by the end of the year is
like 3 weeks for 100 points on the S&P.
Well, you got the shutdown.
Not even that. You have the
is really the
shutdown,
last
but
catalyst.
any buys off of shutdowns are always good buys. So you want to buy that. The problem I have with testing it is not the time frame. It's just that people take off a lot of time around the holidays. So no one ever pushes down a dull market. So people are not at their desks. You don't get the liquidity. You don't have the opportunity for a sell-off. But I would like to see them test it prior to the end of the year.